Josh Grant is a loan officer at Finance Factors, and he specializes in a variety of residential loans here in the state of Hawaii. He's a second generation loan officer with over 14 years in the finance industry, with 9 of those years spent in the local real estate market and mortgage market. Through that experience, he's developed a deep understanding of the unique challenges and opportunities that come with owning a home here in Hawaii. Besides helping families obtain their dreams of home ownership, he spends his time with his family, friends, outdoors, and deepening his knowledge about the Hawaiian culture and the island that he calls home. He is a Mid-Pacific Institute graduate and hula practitioner for over 20 years with KaweQ. One of his proudest accomplishments comes in 2023 when he was honored with a nomination for Best in Real Estate by Finance Factors. This recognition is a testament to his dedication to excellence and commitment to providing top-tier service to his clients. He strives to make the home buying process as smooth and stress-free as possible, leveraging his expertise in a wide range of mortgage products to find the perfect solution for each client's needs, whether it's navigating the intricacies of Hawaii's real estate market or securing the best possible terms for his mortgage. You got it. We can hear you. He's here to guide you every step of the way.
Thank you, Bob. Thank you, Judy. I appreciate that. It's having some technical issues there.
You're welcome. No worries.
All right. So just yeah, I know we're kind of running a little behind schedule, but Judy, I know you're kind of used to writing things, so just I'll let you take it over for the time being until you're ready for me.
Okay, great. Are you ready to show your presentation? I think we're all set if you are.
Yes. Is it not showing on your end?
It is not. Go ahead and click the show
screen. One moment. Hold on.
Thank you for your patience, everybody.
Yes, thank you, everyone. Sorry about that.
Okay, so you should have a pop-up that just popped up on your screen. Perfect. There you go.
You can see it now? Perfect. All right, great.
Thank you.
Yes, of course. And then just change.
And for everyone listening in, remember this is an interactive webinar. So please, as we go through Josh's presentation with Finance Factors, please make sure to put your questions into the chat box. And then at the end of his presentation, we'll head into Q&A. You set?
Yes.
All right.
Yep, I'm all set.
Take it from here.
All right. Thank you, Judy. Yeah, thank you everyone for waiting. So I'll just cut right to it. As far as you guys know, we're in a very interesting environment when it comes to just the economy, mortgages as a whole, the real estate market, everything in general. So basically what we want to do here at Finance Factors is basically just give you guys different options in order to not only help you guys close more loans, but to help your clients as well too. Because at the end of the day, that's what we're here for, right? To service our clients and to basically give them or just direct them in the right direction, so that way they feel confident knowing that they are getting into something that they can, one, manage on their own, and two, just have reassurance that we're looking out for their best interests and we're not here just for a paycheck. So one of the things that I believe that Finance Factors is huge in is our non-QM toolbox. So what's important about our non-QM toolbox is whether we're in an up or down mortgage market, having diverse non-QM products is vital for offering flexibility and meeting your different borrowers' needs. By having multiple options ensures access to housing finances, even when traditional avenues may not be available, right? And so, as you guys know, as Finance Factors, sorry, go to the next screen. Why is it not going? Sorry. There we go. So as you guys know, Finance Factors has been around for 70 years. We provide a lot of mortgage solutions, non-qualified ones especially. I believe that it's important to approach each deal and scenario with an open mind, right? Sometimes we can get one-track minded, thinking that this is the only way that they will be able to qualify and not necessarily think about alternative options, right? And living in Hawaii, we're living in a melting pot, and there's just people from all walks of life, right? Whether they're first-time home buyers or experienced real estate investors, we come across people from all different avenues, right? And so we should be able to give them the different options and feel confident about giving them those options as well too, right? So what a saying that Finance Factors kind of adopted, and I feel like has been just kind of a part of Hawaii lifestyle is, if no can, we can. Of course, there's been different ways of saying it, like if no can, still can, or if no can, still can, but just gotta try harder, right? And I feel like sometimes we just gotta try a little bit harder, we just gotta try a little bit more in order to get that extra deal in, get that borrower the house that they want, so on and so forth. And so, I'm not going to put my foot in my mouth and say that we can do everything. I'm not saying that. But, we can do a lot of other things that other traditional lenders can't do, right? And so basically, I'm going to kind of go over, the products that we are able to offer on our portfolio. And so that way we can help you guys get that extra deal in. And like I said, we're not here to get all your deals, but if we can help you guys get 1, 2, maybe even 3, 4, 5 deals in through the year, that's better than nothing, right? That's better than letting those deals fall to the wayside. So that's what myself, as well as all the other LOs that work for Finance Factors, are here for. We're here to guide you guys into the right direction and hopefully get those extra deals for you, and then build that relationship between your realtors as well as your borrowers as well too. Okay. So one of the topics that I'm going to dive right into is our unusual properties, right? So our unusual properties, they consist of tear downs, unpermitted structures, condotels, residents with farming activity, multifamily properties, apartment buildings, and commercial properties, right? With tear downs and unpermitted structures, they kind of go hand in hand because, in Hawaii, a lot of times people, they want to get creative. They build an extra bedroom or bathroom, or maybe several of those, right? And maybe they don't, take the best care of it, so on and so forth. But a lot of those times, those properties kind of get overlooked because of the intricacies that went into building that property now is becoming a headache for the next person, right? So a lot of times people think you don't want to deal with it, but that's also a deal that you're passing up on, right? And a lot of times they're not as complicated as you think they are, right? And so that's why we want to kind of shed some light, help you guys realize that, even though these deals seem complicated, they're not as complicated if, you have the right source of information, the right products, so on and so forth. Okay. Our next topic is going to be our unusual situation. So we can go up to $5 million on jumbo loans. We deal with a lot of self-employed borrowers. We do have our DSCR program that is tailored for real estate investors. Foreign borrowers, we can assist with bridge loans, construction, and small developers. We also can do first mortgage HELOCs and HELOCs up to $1 million. So of course, it's always great to have those big deals in, because who wants to deal with 10, $500,000 loans when you can deal with one $5 million loan, right? Of course, it's not going to come across your plate every single time, but at least you have us as an option, and we are able to assist with financing when it comes to that. We can also assist with low down payments, so 100% gift funds are okay, right? 100% financing with multi-collateral loans, I'll dive into that a little bit later. And the use of equity in your parents' home as a down payment also. So that kind of goes hand in hand with your multi-collateral loans. And like I said, I'll kind of go into that a little bit further into this presentation. So for DSCR properties, or the DCR loan, this is one of our new programs that we had for, I think, about a year or two, if I'm not mistaken. What's great about the DSCR program is that it limits the amount of documents needed from the borrowers in order to help them qualify for the loan on the subject property, right? So if, for example, the borrowers, let's just say, don't have the best self-employed income, right? And just want to just primarily focus just on the subject property, we can use the DSCR program. So it's only good for investment properties. Can't use it for second home or owner occupant. Loans amount can only go up to $1 million. The qualifications are based on the cash flow of the property. The way that is calculated is it's going to be calculated by the net operating income, which is going to be off of the appraisal, and then you divide that by the principal, interest, taxes, insurance, and association dues, and that's how we are able to determine the ratios up front. Okay? And so by doing this, it does help out a lot of people with certain situations. Now, I'm not saying that, again, we can help out all your customers with this program, but for instance, I'll share a short story with you guys. I had a broker reach out to me. There was 3 sisters. The 3 sisters were the trustees of the mom's family trust as well as power of attorneys. And so all 3 sisters needed to sign off on the loan, but all 3 sisters were living on Oahu, or one was living on Oahu, one was living on Maui, one was living in California. One was a doctor, one was a lawyer, and the other was a teacher. So as you can see, they're very busy people. They just were newly named as trustees of the trust. And, of course, mom living elsewhere, documents are all over the place. And the mom was now being transitioned over into a nursing facility because she was she had the later stages of dementia. So, of course, you can see how that can cause a lot of issues, through the family, and just having to deal with, just elderly care as a whole. Because as you guys know, elderly care is not cheap, it's very expensive, and money can just dry up, or can not dry up, it can be used up really quickly when paying for those expenses. So, time was an issue. And so, just to kind of relieve a lot of the stress from the borrowers, we use a DSCR program because the property was free and clear. They only needed to extract several $100,000 in order to, pay for the mom's expenses for the next couple of years, right? But basically, the property has been rented out for years. They've had long-term tenants, so everything just fell into place, right? But by doing this helped the family secure, secure money in order to pay for the mom's expenses, but also to limit the amount of stress on their end too. So we're able to do that by using the DSR program and helping them in that situation. Now we also have something similar, which is called a Easy Investor program. Again, it's a no tax return program, but we do rely on the Schedule E. So that being said, if the borrower has multiple properties, we do rely on the rental income from those properties, right? So we don't stress out too much about anything else on the tax returns. We just focus on these properties, right? So those are 2 programs that we can basically use when it comes to real estate investors, and especially helping them get the financing that they need in order to do what they want to do, whether it's to, have the liquidity, to have the cash on side to to invest into other properties or to rehab the property, so on and so forth. It just gives them that opportunity, right? So then that goes into, oh, I'm sorry. So this is kind of how it's broken up for the DSCR program. There is a minimum FICO score of 700 to 739. The LTV is at 65%, and then anything over 740 is up to 70%. So when you're looking at our DSCR rates as well too, the LLPAs are already added in. So if you have any questions as far as the LLPAs and the add-ons, please reach out to us so that way there's no miscommunication or any misunderstanding as far as how it's being calculated, and if your broker compensation is calculated to that as well too. So we can kind of go over that a little bit further when we're going over scenarios. The properties also have to be in good condition and readily marketable. That's very important. It can't be in tear down condition, right? And we also need to have 6 months of PITI reserves in order to do the DSCR program. Okay. So this now leads to my next topic, which is properties in poor condition, right? So this is what I was mentioning earlier, was that a lot of times we kind of overlook properties because they may need a lot of work, or we don't want to deal with it, so pass it on to someone else, right? Or maybe that's just other people's thought process. But when it comes to properties in poor condition, we have either our alt rehab program or our extreme condition program, right? What's good about both programs is that basically, depending on how much the renovation costs are going to be, each program has its perks for it, right? So, for example, let's go back to it. Sorry, our alt rehab program, that's good for properties that are experiencing just very minor deficiencies. So, for example, if the rehab is going to be between 20,000 to 100,000, then that falls into alt rehab. Anything over 100,000, now we're looking at extreme condition. Now the property doesn't have to necessarily be in tear down condition to fall into extreme condition, but it definitely has to have a lot of rehab has to go into it in order to make it livable again. So basically, that's kind of how we would look at those properties depending on how much it's going to cost to rehab the property, right? So when it comes to our poor conditions, we do allow for deferred maintenance or a tear down. And then when we appraise it as is. The buyer must have evidence of sufficient funds to cure the property. Now, for example, if the borrower already has a property and they own it and there's enough equity, we can lend out the money to the borrower in order to repair the property. What's also great about these two programs is that, different from the construction loan program, we don't require bonding, and we are a lot more lenient when it comes to letting the borrowers basically build on their own. Now, we still want to have a construction estimate, so we do want a contractor's estimate to know exactly what is going to be completed, right? And also the cost of to complete the project, right? Because we want to make sure that it's within reason, and also that it's within our program guidelines. So it's very important to make sure that we have all this known upfront before we even submit the application, right? So that's very important when dealing with poor condition properties. So we also allow for unpermitted improvements. So extra kitchens, no interior access, extra rooms, like I mentioned before, we do allow for that, right? Now, we also, when we appraise it, we have to appraise it as permitted with the cost to cure. Now, I had another situation where I unfortunately couldn't close this deal, but it was a extreme condition property. The property was not taken care of properly because it unfortunately was rented out to college students, and college students did not take care of the property. But what the owner did was that they converted this permitted three dwelling property that between the three dwellings had 8 bedrooms and 4 bathrooms permitted. But what the owner previously did was that he converted all three buildings to have 20 bedrooms and 10 bathrooms. Right? Yeah, it can generate a lot of income from the rental, but you know, when we actually have to rehab the property, we have to go with what's permitted, right? I mean, of course, we have to go with what's permitted, right? It's just plain and simple. So that's basically how we would have to look at it if we're dealing with a property in that type of situation. So now that leads to my unusual collateral and zoning. So we do allow for condo towns, unlike other lenders, we do allow for condo towns that have kitchenettes or don't have kitchens. We don't have any restrictions on square footage. Um, Basically, as long as there's no issues with the condo towns, right? Like there's no what is it? Of course, as you know right now, if the property is underinsured, that's not really a situation we want to get into too much. But also, if there's any litigations, right? We have to really look at the litigations and see if this is something that we want to take on as a risk, right? So we are able to lend on condo towns, but of course we have to really look at it, okay? Um, Another thing too is that we are able to lend on ag zones, including large acreages. Normally, we want to keep it under 5 acres, right? Anything over 5 acres, the LTVs are gonna drop drastically, right? Basically, anything over 5 acres with a home, we're looking at 50% LTV. Anything under 5 acres, we do have a little bit more leniency and we can go higher in LTVs, but it also depends on the loan amount and the FICO score as well too. So depending on the situations, we can kind of dive into that a little bit further. We can also deal with properties that have farming activity, right? As well as incomplete constructions. With that, we want to make sure there's no mechanics liens, that all the permits are in place, so that way, if we do take on this risk and liability, that we're able to basically hit the ground running and complete this construction so that way it's not lingering and on our books for too long. And also we want to help the customers basically move in the right direction and guide them in the right direction so that way they can complete this, right? Because as we all know, construction can be a headache, right? Because there are some times when things pop up that, go overlooked, so on and so forth. So it can be a stressful time for the borrowers. So, we definitely want to try to do our best in order to make sure that the borrowers are in the right place and are educated enough to know, what they're getting themselves into prior to that, right? We also deal with multifamily properties, apartment buildings, industrial mixed use, and commercials with grandfather single family dwellings. So with our commercial department, we're able to work with them hand in hand directly. So that way we can help our borrowers, especially our real estate investor borrowers, make purchases like this, right? Because granted, this isn't going to be a purchase that a first-time home buyer is going to be purchasing, right? It's usually going to be a more experienced real estate investor. So now that leads to the bridge loans, reverse 31 exchanges. This is one of my favorite programs that I like to use, or at least try to offer and educate brokers, realtors, borrowers about, because it can be used as an advantage, right? Now, that being said, as soon as I bring up the word cross collateral, as you guys can see, a lot of people start to kind of get very defensive or weary about the fact that they have to now put another lien or a new lien on a property that they currently own, right? Now, it's our responsibility to educate the borrowers, the realtors, whoever you're dealing with, that this isn't a bad situation. If anything, this is a blessing in disguise, right? Not a lot of people are can say lucky enough in order to have family members who may own equity, or sorry, who own a property that has enough equity to help with a purchase of a transaction, right? A lot of times people bought them at 3%, 5%, 10%, 20%. Even with that, it's not a whole lot of equity to work with. But let's just say mom and dad, grandma, grandpa, they've been living on the islands for a while. They bought the home back in, I don't know, the 60s for $70,000, something ridiculous like that. And now it's just worth 1.5 mil, right? Something of that extent. It does happen. I'm not saying it happens to everybody. Not everyone is as lucky, but it does happen. So by just kind of digging a little bit more, finding out a little bit more about the borrowers, their situation, their family, we do this anyways, just trying to get to know the borrower anyways, just during a normal conversation, right? So by doing so, we want to come across as an expert. And by doing that, we have to have these other products, right? And so we have to now basically coach our customers and tell them that, hey, this cross collateral is not a bad situation. You guys are lucky. You guys are in a very excellent situation to use this in order to purchase a new house, right? Now, bridge loans, for example, people see a home that they like, right? And let's just say it's a hot market, that property is probably going to be off the market within a week or two, right? And chances are, it could be, right? And let's just say the property that they want to depart isn't ready to sell yet. Maybe they need to do some touch-ups, they got to do some things in order to get it ready, stage it, all that kind of stuff, which takes time, right? But at least this gives them the opportunity to purchase the property first, and then they can sell the property later. Now, this can be a 2-for-1 deal for your realtor partners, right? Because now this realtor is assisting your borrowers with the purchase, and now they're also assisting them with the sale, right? So by doing that, you are now building a relationship with your realtor, because now your realtor gets twofer, right? And so it can also be a twofer for you too, right? Because sometimes too, let's just say the borrower doesn't own the property, or the borrower's parents don't own the property free and clear, and there is a lien, right? And so let's just say they have to pay off a balance after they sell the property, right? So by doing that, you basically just have to refinance them out. So as long as they qualify to be refinanced out after the bridge loan, right, then we can go ahead and move forward with it. Basically, we want to have an exit strategy, right? Whether it's from selling off the departing resident and paying off us completely, or selling off the departing resident and paying off us partially, and then refinancing it out later on. As long as there's an exit strategy where we can help the borrowers get out of this, then this is going to work to their advantage. And again, like I said, this is a twofer for you. You get the brokered in bridge loan or 1031 exchange, and then if, for example, like I said, they can't pay off the whole entire balance after the sale of the property, then they can refinance it out, and you can refinance them out into a smaller 30-year fixed loan, right? So that's how this bridge loan can actually work to your advantage and actually help you basically bridge that transaction or bridge that gap in order to help your borrowers get the home that they want, right? What's also good about the bridge loan too is that if there's enough equity, we can finance up to 100% of the purchase, right? Because at the end of the day, as long as we get paid off, that's what we're looking for. So basically, the borrower and the realtor have 12 months after the bridge loan has been finalized in order to sell that property to pay us off. Okay, it's more than enough time to get that done, and before we even close the loan, we want to have the realtor ready to basically market this property. So we will ask for a marketing plan for the realtor or from the realtor in order to make sure that, okay, as soon as this is done, the realtor is going to hit the ground running and they're going to start advertising this property to get the sale, right? And so most times they get it done within a year, right? If they don't get it done within the year, reach out to us. we'll try to figure out a solution again, but at least, you have that option. Okay. So now that leads to my foreign borrowers. Okay. So foreign borrowers, of course, they don't need to have U.S. credit. We verify the income, the assets, based upon the translations, right? So depending on how many documents that need to be translated, there will be a translation fee. Now, we do have a service where we can do this, I believe, through a third party. So just grab all your documents from the borrower, send it over to us, we'll translate it, and then the fee will be assessed, and then it'll show up on the loan estimate as well as the closing statement as well too. So for as far as the alternative credit, normally we'll just ask for bank references letters, credit card statements, things like that, in order to show that the borrower, has some type of repayment history. So that way, we feel a little bit more reassured that that borrower is going to be paying us back as well too. We also require naming of a personal representative. So because the borrower is in another country, we do require someone locally, so that way we can get in contact with them. And that person needs to know how to be able to get in contact with the borrower as well too. We also require 6 months of PITI as well as maintenance fee if it applies, for the life of the loan. We'll collect that, we'll put it into a finance factor savings account in order to satisfy this requirement. We also start with a minimum down payment of 40% when it comes to our foreign borrowers. Okay. So, like I mentioned before, we have a lot of unusual situations. We have our $5 million jumbo loans, self-employed borrowers, investors, and irrevocable trusts. So I really try to push the whole irrevocable trusts when it comes to educating borrowers, because here in Hawaii, we do have a lot of old families. We have families who have irrevocable trusts. Working, in the deposit side for 5 years, I've dealt with a lot of families coming in and opening up checking, savings, CDs with irrevocable trusts, or the trust converts into an irrevocable trust later on because the owner passes away, so on and so forth, right? So a lot of times, a lot of lenders, won't assist the borrowers who have irrevocable trusts. We'll do it, right? So if you have any borrowers who have irrevocable trusts, please reach out to us. We want to help them. We want to help them maintain the assets that they have within their family, so that way, generations later on are able to, benefit from it, right? And that's what we should be in the market for, is to help our borrowers, grow, right? As not only as people, right, and educating them more with the education or with the knowledge that we know, but to help them grow, financially, as better people as well too. So that's what we're, basically here for, or at least I feel like I'm here for. Construction and small developers, like I mentioned, first mortgage HELOCs, and $1 million HELOCs or $1 million plus HELOCs as well too. So like I mentioned earlier, on the bridge loans, we have our multi-collaterals, which takes 2 or more properties, and you're using the equity of these properties in order to help the finance of the subject property, right? Whether it's a purchase or refinance, to get cash out. Basically, we can cross-collateralize the properties. What's very key, though, is that these properties do need to be in the state of Hawaii. Can't be in Alaska, can't be in North Dakota, on the mainland U.S., can't be in Guam. It has to be all in the state of Hawaii. Now, let's just say the subject property is on Oahu, and borrower has properties on Maui, Kauai, and Big Island, right? Totally fine. We can cross-collateralize those properties as long as the equity's there, right? And because they're in the state of Hawaii, we can look into it. Now, we also have to take a look at the zoning too. So now I'm not going to say that it's completely okay and, every single property is going to fit into this bucket. We still have to do our due diligence. We still have to, look at the zonings, make sure that our LTVs work out, so on and so forth. But is an option for our borrowers out there, right? And like I mentioned, we can finance up to 100% of the purchase. The borrowers don't necessarily need to bring in cash in order to make a down payment, right? If the equity is there, from another property, we can use the equity in order to make that purchase, right? And I'll show you a short breakdown of how we can use that or do that, right? So like I said, it's great for experienced investors and small developers, or even first-time home buyers. It doesn't have to be experienced investors, right? It can be someone who's just getting into investing, right? But they're looking to us to educate them. So that's why it's important to have this knowledge, right? Properties in poor condition, like I mentioned, you can pull out the cash to make repairs. We definitely want to see the properties improve, right? It's better for the company, and also better for the borrowers as well too. So, we definitely want to help them with that. And then it's also, like I mentioned, ideal for first-time home buyers who need to use the equity from the parents' property, because sometimes we don't have the 3% down, we don't have the 5%, 10%, 20% down, whatever percentage it is, in order to make the down payment, because let's face it, Hawaii's expensive, right? Just the cost of living, just to save up money is hard. But like I said, there's certain instances and circumstances where borrowers are lucky enough to, have the equity and have mom and dad, grandma and grandpa, help out with that. And, they should definitely take advantage for that, right? And so going on to how the multi-collateral works, the first lien needs to be placed on the new property and the first or second lien placed on the existing property, right? The uses of the equity in the existing property is in place of a down payment, okay? So here's the example. You have a new property, the purchase price is $800,000. The existing property is appraised at $600,000, right? The combined value is 1.4 mil, okay? In order to purchase the property, of course, you need an $800,000 loan because you're not coming with any down payment, okay? And let's just say there is a small balance on the existing property that's valued at $600,000, and the current balance is $100,000. So combined loans equal up to $900,000. So now we divide $900,000 divided by 1.4 million, and our combined loan to value is going to equal to 64%. So now we have 36% of down payment. So that's basically how it works. And you can, change out these numbers and play around with it to kind of figure out, okay, can this situation work for my borrowers? Do my borrowers fit in this type of situation? So on and so forth. But if you ever have any questions as far as, am I calculating this correctly? Am I looking at the equity correctly, so on and so forth, reach out to me. Reach out to any of our loan officers. We'll help you with calculating the correct CLTV, because this isn't a program that you do every single day, right? And we want to make sure that we get everything correct up front. That way, it lessens the amount of headaches down the road. Okay. And so, basically, just in closing, like I said, I'm not here to get all your deals. We're not here to get all your deals. We know that we can't do everything, but we can do a lot of things that other lenders can't do. So whenever you are faced with a situation where you're like, oh shoot, I can't do it this way, just think, well, you know what? If no can, we can. Well, finance factors can, right? So just remember that. Just reach out to us. Whether we can do it, we can't do it. At least you tried. And that's the main thing, is that we try the hardest for our borrowers, and that we are here to educate them, and we are looking out for their best interests. So
You're so amazing,
that's all that I
John.
have for today. I know I kind of breezed through a lot of these things pretty quickly. But if you guys have any questions, I'm going to be opening up the floor for Q&As right now. And if we're not able to get to those questions, then, feel free, shoot me an email, call me up, whatever it is. I'm here to help. I'm, anxious to help you guys and, getting more deals in.
Thank you so much, Josh. What a great presentation. And I've always been a big fan of Finance Factors and, of course, your slogan, if no can, we can. You know, Finance Factors has always been known for being the catch-all lender. One of the things I've always loved about Finance Factors is even if it doesn't fit the program, like you said, give you a call because there are exceptions to be made
Exactly.
at
Yes.
Finance Factors, you know,
Yes.
LTV exceptions, DTI exceptions, you know, as long as the compensating factors are there, as long as the deal makes sense, you know, it's always been a pathway to success. So I really love that you
Correct.
all of that out. And I did hear something that really jogged my interest in your cross collateralization program. Previously, many years ago, when I closed a bridge loan with Finance Factors, it was always that the existing first lien on one of the cross collateralized properties was replaced with the bridge loan. But what I
Mhm.
heard you saying is that now you've got a component where you could leave that first mortgage in place. You're adding a second lien, perhaps, in order to grab that equity and then and use it along with the equity in the other properties or the new properties that purchasing. So is that the case that you guys are allowing a second lien so that they could leave the first lien in place of their existing residence?
Well, for the bridge loan, basically what's happening is that, yeah, they are planning on selling that property, right? And so that's kind of the difference between the multi-collateral as well as the bridge loan, right? So the bridge loan is using the multi-collateral concept where we're collateralizing both properties, right? But in the end, the bridge loan, you're selling that property, right? So yes, we are putting another lien against that other property. So if that other property has a first mortgage in place, then we're leaving that first mortgage as is, right? Um, but of course, they're going to be selling that property, so that first mortgage, is gonna. Oh, I'm sorry. I'm confused. Getting myself. Sorry. The bridge loan, I'm sorry, is going to be paying off that first mortgage. I'm so sorry. Um, so we're going to be paying off that first mortgage, and then the mortgage is going to be a blanket mortgage because it is an interest-only mortgage, and it's a short-term mortgage for 12 months. Now the cross collateralized, right? If, for example, the property they're not intending to sell, right? But the property has a first mortgage, then we're leaving that as is. So the bridge loan, we would have to pay off the first mortgage on that existing property because basically they're going to be selling that property. But if it's cross collateralized and they don't sell that property, then we can leave it as is. So it's kind of a little it can be a little confusing, I guess you can say, because they're very similar, but at the end, what we're looking at is what's the exit strategy, what are they trying to accomplish at the end, right? And so depending on what they want to do at the end will dictate whether a bridge loan will work better for them or a multi-collateral loan, right? So it all depends on the borrower situation and the scenario at hand.
That's awesome. And I think that that's actually a great example of why before as a loan officer, I will want to dive into the different guidelines and assume that I know which direction to head, that I should be giving you a call to make sure that I'm understanding, digesting the programs correctly, and of course, making the proper choice based upon newer guidelines or more enhanced guidelines. So I think that's awesome.
Correct. Yes. Yeah. Yeah. And I mean, like I said, we're not trying to get all your deals, but at least as far if I can help you get those deals in order to, close it, that's what I'm here for.
Awesome. Thank you, Josh. So for everyone listening, the chat box is open for any questions that you may have for Josh. And so we'll give it just a couple more moments. If you want to, I know we got started a few minutes late, so if you guys want to hang out with us for a few more minutes, we'll just give some of the folks an opportunity to ask any questions that they want to. While we're waiting, Josh, why don't you tell us a little bit about what you do for fun when you are not sitting at your desk solving everybody's problems?
Of course. Yeah. So I mean, kind of stated in my bio, like I've been dancing hula for oh shoot, close to almost 20 years, I think, over 20 years. Just on and off. I've been dancing for Halau Q. We um, have been around for over 25 years. And we just got back from Mary Monarch this past year. We competed, and it's always a great experience. So I do that, usually on Sundays. In my other downtime, I like to spend time with my son. He's 9, and he's just like me. He's kind of a beach boy. He likes to just be out in the water. He likes to, hunt for things in the tide pools, and I'm just starting to show him how to start fishing, but also respecting the Aina, and just um, take what you're gonna take, but also release back into the ocean what you aren't going to take, right? So that way other future generations are able to partake in the same activities that I'm able to share with my son. So I just like to hang out with a lot of my family, my friends. Anything that takes me outdoors. I don't know, I like being in nature. And I feel like through hula I've gotten a lot of experience through that, through like lei making, making a lot of our costumes, things like that. So it definitely has given me a chance to experience what this island culture as well as the Hawaiian culture has to offer. I'll just say right off the bat, I'm not Hawaiian. I am actually half Filipino, Korean, and Irish, but I just fell in love with hula when I was a freshman in high school, and ever since then, I just been dancing. It's just a way for me to kind of alleviate some stress and just keep in good shape and just I don't know, get rid of nerves, things like that, But yeah, I definitely, try to do what I can to stay active and, be out there in the community and just to, educate myself more about just everything around me.
That is so awesome. Thank you for sharing that with us. So very awesome. And congratulations on Mary Monarch.
Thank you.
It looks like we've got a couple of questions coming in, Josh. So the
Yeah.
first one comes from Dave Ige. Do you have a P&L second mortgage?
Um, we do not have a P&L second mortgage type of program. When it comes to P&Ls, let's see. We or just let me backtrack a little bit. When it comes to self-employed borrowers, we still want to see tax returns filed. Now, let's just say there are times when borrowers, are behind on their taxes or filing their taxes, right? So we are willing to look at year-end P&Ls, year-to-date P&Ls, things like that. Of course, we want them to be drafted up by a CPA, so that way everything is in line. But other than that, we don't have a specific P&L program per se. But we do, have times when borrowers don't have their tax returns up front, and we do need to look at their P&Ls.
Thank you for that, Josh. Next question that we've got coming in. Can you do mixed use properties? Example, 4 units residential and 3 retail on the bottom floor. So that would be 4 units residential and then 3 retail on the bottom.
So we can do that. That would actually fall into our commercial loan program because of the fact that there's retail space below. Um, Granted, I don't deal with commercial loan programs directly, so that's a question that's probably better for one of my colleagues. Like I mentioned, we do work hand in hand with our commercial loan department. So if you are ever running across um, a property that kind of fits within that structure, please reach out to us, because then we are able to land on that. But of course, the criteria has to fit within our guidelines. So we can kind of dive into that a little bit more as far as how much rent that's going to be generating, so on and so forth.
Awesome. Thank you so much. And maybe since the question was asked, talk a little bit about your second mortgage program, because that's relatively new for finance factors.
Yes, I mean, well, we've actually had our second mortgage programs for a while now. It's just that, I mean, at least from my experience, they don't happen too often. Usually our second mortgages are usually HELOCs. A lot of times people will take out a HELOC, especially in this current environment too. A lot of people either purchased or refinanced the house during the low interest rate craze, and so they don't want to really touch their first mortgage, right? So now they're coming to us asking, okay, well, we don't want to refinance that first mortgage, right? Because we're, paying so little bit. What can we do, right? So, we do have a fixed second, or we have, a HELOC as a second. So depending on what the borrower intends on using the funds for, you know, we're able to help them with either one. So as long as they can qualify, we can help them with that second mortgage. Now our HELOCs are great because one, as long as the borrower is requesting for a loan amount under 400,000, right? We don't have There's no LOPA charges if it's owner occupant, right? There is no points. We go off the tax assessed value, so we don't have to run a full appraisal. We don't require the borrowers to make an initial draw. So if the borrowers just want to have the line, of credit just in case, that's totally fine, right? Um, and so there's a lot of benefits when it comes to using our HELOC program as a second mortgage, and as well as using it as using our close end seconds as well too. So like I said, it all depends on the situations, but we've had it for a while. It's just it's not one of our most used products. Yeah.
Absolutely. Thank
Yeah.
you for that explanation. And then the final question that we've got coming in is, how is Finance Factors dealing with Hawaii condo insurance issues?
Great question. So right now we don't have a definitive fix for that situation. We are still, like a lot of lenders, kind of seeing where things are going. Now, I'm not saying that we can't do certain projects, but as long as at least the building isn't, how can I say it? If the coverage isn't too far off from the value of the building, then we may be willing to take a look at it and be willing to use our cross collateralized program in order to take on this risk, right? Because right now technically we do consider it as a risk, right? Unfortunately, but as long as the borrower is well qualified, they have good income, good assets, LTV is low. Like I said, there's enough insurance coverage, even though it's deficient, we feel okay with proceeding forward. We'll take a look at it, right? It's not a guaranteed yes, but we'll take a look at it. So there is a possibility, but I'm not saying that it's a clear-cut yes or no answer. So it definitely, just run it by us. We'll take a look at the bar as, from the big picture, not just from that property standpoint, right? But we're looking at the bigger picture, and we may be able to assist them. So just run it by me, run it by one of my colleagues, and we'll take a look at it.
And I think that's great. That's another example of flexibility when it comes to Finance Factors and being so solution oriented.
Right. And sorry, just to refer back to because I remember you mentioning that we do make an exception. So that would be an exception case. Like you mentioned earlier, we are willing to look at every single file, and we are willing to make exceptions when needed in order to help assist the scenario. But yeah, exceptions aren't outside of the norm. So if there are times where the borrower is just on the borderline, or we just kind of need that exception in order to get it through the door, we'll be willing to kind of like look at it and say like, oh yeah, I can get an exception for this, or I may be able to put an exception for this, because we feel confident enough that this is something within, finance factors' appetite, right? So that's basically how we, as as loan officers, want to try to help you, right? We want to basically know what we're finance factors is willing to take on, and help you guys and guide you guys so that way you can get those deals over to us, right? So that's basically how I would look at it.
That is awesome. Well, it looks like we've reached the last of our questions. Thank you everyone for being here with us today. Thank you, Josh, for being here with us today. Everyone with your scenarios, please reach out to Finance Factors, reach out to Josh. His phone number is still here on this on the screen for you. And we look forward to the next time that we see you, Josh. Thank you so much for sharing all that great information today.
Of course, thank you guys so much, and thank you for your time, and thank you, Judy and Angel, for setting this all up. And sorry guys for all the technical difficulties. But it was my first time. Hopefully the next time will be a lot smoother and a lot better. So
Thank you, Josh. You were amazing. Thank you, everyone. And we'll see you on the next webinar and at the next Hamby events. Thanks so much.
thank
Aloha,
you. Aloha,
everybody.
guys.